Would have liked to see it fade out, but that's okay. Welcome, everyone, to the Sunday night strategy session for July 12th, 2015. Very nice to see everybody this evening. Let's go over the economic reports that are due out this week. As soon as I pop up the questions, okay, there are no questions. So today with the Eurogroup meetings and the Euro Summit, tomorrow you'll have that too. 5 a.m. you have the economic sentiment in Germany, ECOFIN meetings all day, core retail sales in the U.S., they're rated red, business inventories and import prices. Business inventories is during the session, the others are pre-market. That is on Tuesday. Okay, on Wednesday, PPI, pre-market, core PPI, Empire State Manufacturing, capacity utilization, industrial production, again, all pre-market, but 10 a.m. Yellen testifies. So we have to watch that. Crude oil inventories at 10:30. The beige book used to be an orange. Now it's a yellow. Means it's downgraded its importance. I don't know. FOMC member Williams speaks Thursday. Got some action overseas. The minimum bid rate, the ECB press conference, weekly unemployment claims. Yellen continues to testify. Philly Fed manufacturing, NAHB housing market. So, wow, a lot of red on Thursday. And on Friday, building permits, which is now a red. I remember when that was an orange. CPI, core CPI housing starts, and preliminary University of Michigan consumer sentiment, which is also during the market. So the reason I mention this is that pre-market stuff, maybe it will influence a gap, but if you're trading intraday, you have to really be cognizant of what's going on and what's being reported during the day, because you may get shaken up by that. Okay, so you just have to make sure you're paying attention to that, okay? As of right now, the futures are down about 11 points or so. There is still talk about Greece all over the wires and China, and Paul's going to talk more about that. But, you know, as of right now, the S&P 500 is holding the 200-day moving average. Okay, that's as seen by the SPY. It is coiled up here. It's also at the 127% external retracement of this last swing. And what we're looking for now is to see if it releases one way or the other from here. Okay, I have a line in the sand up here that I'm looking for as my stop dead point if I'm going to be correct, and this is the high of the year. Again, I said this to the mastermind session at 7:20. I don't really have an ego involved in this. I really don't care if I'm correct. I just like having a stop dead point for my own analysis. Okay, so this isn't an ego play for me. I'm not going to say, see, I was right. It's just a stop dead point for my own analysis. And really, now that I am fiddling with Elliott Wave, I would like to see if I can get my hands around its throat, because for many years I could not. Not really a good Elliott Wave guy, so or gal actually. I'm not a good Elliott Wave girl either. But anyway, some Elliott Wave practitioners that I do respect, and not because they're never wrong, because everybody's wrong at everything at one point or another. The people that tell you they're never wrong, they're the people you should run away from. So just to let you know. But anyway, they're calling this an A down, B up, C down, and suggest that we go to new highs sooner rather than later. I don't see it that way. I see this as the start of a bigger correction. I don't think a bear market has started, but I think that we're going to correct for a while and then not see new highs again until next year. Of course, all that is all academic because we're looking at the short term, and the short term right now is we are coiled up. The short term right now is telling us that we have to wait for a move. We have to wait for the market to tip its hand. That's all I have. If you have any questions, you can always write to me at tiny@winningedgetrader.com if you'd like to get on board and join the inner circle for our weekly newsletter and daily video updates with market analysis and stock trades, ETF trades, and of course, you get to come to our early Sunday mastermind session, which is early evening, I should say, or early night, 7:20 p.m. Eastern, and you can ask all your questions on anything, and I do my very best to answer it. So without further ado, I'm going to hand it over to Mr. Schatz, and that's it.
Thank you, Mr. Saul. I'm just finishing moving my screen around. Okay. Tiny, what did you say? All is well in the world and we're going back to all-time highs this week?
I did not say that. I don't think we're seeing a new high this year, but that's me being edgy, because usually I sit on the fence. This is actually me being outside the fence.
Wow, you're turning me on. I'm going to call you edgy from now on.
Yeah, real good. That's probably not going to happen, but we'll see. But I at least I have my line in the sand, which is 210.36. So
I love that line in the sand.
Yeah, I know, because you agree with it. Well, you don't really agree with it, but
I'm just not a line, because I'm not a line in the sand person. I kind of think of most lines more like pillow top mattresses that you kind of ease your way into, and most they hold or they don't. But I think with the proliferation of algorithmic trading, it makes lines in the sand more difficult. In the old days, the lines in the sand worked fairly well. Like if you look at this old high right here, all the bears essentially had the line in the sand at this peak, and I mean they literally just tiny, no pun intended, tiny ticked above the highs here, and then reversed them on a dime. In the old days, even if they were going to reverse, they'd run the stops at least a couple of percent. With the algorithmic traders, they just attacked right here. It makes it much more difficult, I think. So that's just my opinion.
All right, before you start, just check your messages, and then you can go.
What kind of messages?
On this.
Oh, okay, hold on. My message from you?
Yes.
I don't see a message from you.
It's there.
How do I view messages?
I don't know. You've definitely seen it because it's the same one I sent. It's not the same message, but it's.
Oh, there it is, under chat.
Yeah, when you asked me about moving it to 9 o'clock, I answered you that last week. So.
Oh, I see it. It's under chat. I got it.
All right. I'm here if you need me, but I'm muted.
Don't make fun of me for always being wrong. Okay, I won't make fun of you.
Yeah, I wish I said that, but since I'm about as wrong as anyone else except for the thief.
Okay.
All right.
Let's launch, shall we? So let me start by talking about the big picture, and that is similar to what I said last week, which was, and I think the last 2 weeks, I think Greece is not a mirage, but I think Greece is detracting from the real situation, which I believe is China. And amazingly, if you didn't have Greece and you didn't have China, Puerto Rico would be, I mean, headline news. The media would be having those special reports on Puerto Rico. Puerto Rico is lucking out that it's third on a list of China and Greece. But Puerto Rico is a pretty interesting situation because unlike states, it doesn't have, it has a little more flexibility being a U.S. territory regarding its fiscal options. But I won't go into that. This is not a muni bond trading group, I don't think anyway. So let's start with Greece. My feelings are the same that I wrote in my blog and I've mentioned here, and that is Greece should leave and it's funny, Germany's Finance Minister Schauble agreed with me finally. He said, Paul Schatz, you're right, that he thinks Greece should leave the euro for 5 years. Well, I didn't put a timetable on it. I've always said they should leave, period. Let them reflate. Let them. They already have drachmas printed. They're sitting in the bank vault. But I think Greece should leave the euro, default on their debt, print drachmas. Their economy, which is already in a depression, would get more depressed. But I think it'd be a V bottom. I think this nonsense with higher taxes and more austerity and more pension cuts is a spiral. It's not going to work. It hasn't worked for 6 years. It ain't going to work now. So I think they're making a huge mistake. And I don't think, even if they agree to a deal, I don't think we've seen the last of the Greek problem. I think it's just going to come back again. So I would leave the euro. I would turn this whole deflationary spiral into some kind of reflationary spiral, collapse all ability to import, and start over again. Hit reboot. China is much more fascinating. Only a former communist country could get away with completely and utterly, not even subtly manipulating their markets. They've outright banned sales. If anybody owns more than 5% of a company, of an issuer, you can't sell your stock for, I think, 6 months. No more IPOs. A double-digit percent of the stocks in China aren't even trading. There's no market for them. They're having a total liquidity crisis. So to me, China is the much more interesting situation. And they've lost, I think it's like $2 trillion of market cap since June 12th. And I just saw a parallel. There we go. I just saw a parallel. Oh, it's on the wrong computer. Shoot. Okay, I can't pull it up. Somebody had a nice parallel of China now to 1929, both with the news headlines as well as price action, and that we're only in the middle of a decline in China if the comp to 1929 in the United States bears out. I have no idea. I can just tell you that I don't think. Here's the FXI, which is not exactly like like their Class A shares, but it's close enough. I don't think this is the low. Call me crazy, but I don't think that's the ultimate low. I sold some of my China position, which, as you know, I've held it with a lot of pain in the last week or so. I did some selling on Friday right at the close. Actually, it was in the after hours, and I will likely do some selling if China goes higher. The higher China goes, the more likely I am to get rid of my whole position. So if we somehow rally into the 45 area from 43, I will likely dump it all, get out and step away and come back fighting another day. It's giving me enough agita and angst. But China's the bigger story in my opinion. Greece is nonsense. So that's my long-winded intro to where we are. And Scott, I did buy a Tempur-Pedic. It was delivered 75 minutes ago. I walked in the door just now before I came on, but I did buy a Tempur-Pedic. It's upstairs. I have not even seen it yet. So we'll find out tonight. My wife already said I bought the wrong bed, but I bought the exact one she told me to buy. So let's dive in. We spoke about Greece and Puerto Rico and China. Volatility is going to remain high. No secrets there. Here's the VIX. It's spiking, but not like we saw back in October here where it really spiked. It's spiking but remaining elevated, and probably goes up tomorrow morning. So let me start by saying there are a fair number of indicators, some short-term, some intermediate term, that indicate we are in a bottoming process. And I say the phrase bottoming process because to me, price looks a little incomplete here. Not that this can't be the V bottom. Not that this wasn't a V already. I mean, is that possible? Sure, why not? We've seen more V bottoms in the last 3.5 years than in the last 3 decades. But this is possible. It's a V bottom. If this is a V bottom, I do not believe we're going to blast off to 20,000 the Dow from here. But the indicators that I'm watching on the sentiment survey front, on the smart money front, on some of the option fronts are all at short-term or intermediate-term extremes, which means the market could support a rally. Is it the rally where we're taking off? I don't think so, but I'll hop on board if need be. I know a lot of times I've spoken about what I call the gap of recognition, a gap where it's kind of like this, the market gaps down and it doesn't regain the gap, and after a month or so you go, holy shees, that was a tell. Well, so far, right here, we have a gap of recognition. It's been 2 weeks and we've been unable to close this gap. Now maybe we close this week, but the longer we go without closing this gap, the more important this gap becomes. And I would say the longer we go without closing this gap, the more likely we are to take out these lows. So my overall thesis is the indicators support a rally. It doesn't mean we have to get one. It's not overwhelming yet, but they're starting to fall into place. Personally, which the market won't give me, I wouldn't mind seeing, this rally end soon and then have us put another low in, right there. And then, should that scenario happen, then I would make the case that we are going right back to all-time highs late in the third quarter. But that's putting the cart before the horse. Tiny and I don't agree, and there's nothing wrong with that. So before you send us emails saying, well, how could you disagree? Of course we can. We each have an opinion. Neither one of us believe the bull market ended yet. He believes new highs are in store next year. I still think, depending on how the market trades, we could see all-time highs again late Q3 into the fourth quarter. But it's irrelevant right now. Let's get through the short term, figure out where we are. So right now, we are here waiting. That's the Dow. And frankly, the other indices look very similar, probably a touch stronger. The Dow's the weakest because it already took out its March lows with some significance. Here's the S&P 500, which coincidentally just touched the March lows last week, and which is not healthy, by the way. I'd much rather have seen this kind of action, a little more run the stops out and then rally, but that wasn't meant to be. So the S&P could certainly support a rally. It's one of the indices I am long. I'm not long the Dow, but I just don't see us going to wherever we're going, 2,200 yet. Mid caps, I own none, and here the mid caps, look similar to everything else, frankly. A little bit here, a little bit there. Stochastics are all oversold, so again, we could support a rally. We'll see what happens. Small caps, which I got out of, look similar to everything else. They could certainly support a rally. These could go to new highs more than the others. I could see the small caps having a better run, but I'd rather not see it now. And the Qs, here we go on the Qs. Looks like the others, I do own the Qs as well. So major indices continue to look sloppy. It's a term I've used, I think, all year. We're getting closer to launching. Sentiment overall is getting better, but it's not flashing green yet. We're probably back. We went from the red zone to the yellow zone. Here's Europe, which had an absolutely monster day on Friday. I mean, this is huge, this move. Is the decline over in Europe? I think there's a better shot the decline's over in Europe than the United States. We're into the gap a little bit, but I don't want to buy Europe yet either. I'd rather stand aside and wait. Emerging markets look like dog poop. Still, I think you can sell the bounce in the emerging markets. Not interested in getting all my position here as well. It's been a very I loved when I bought Hong Kong. I sold Philippines, bought Hong Kong, and then after I got to here, I realized, oh crap, this is just not good. So, oh well. I said cavalierly. Let me just see if any questions have arisen yet. Jeffrey, thank you. Yep, I know. Hempapeta's got a 90-day return policy, which is, it rocks. So I know we will definitely take advantage of that. Johanna asked me, is there an indicator that we can follow look at from time to time? What is moving the most, growth or value stocks, Paul? Johanna, the answer is yes, there is an indicator you can follow. Hanson, what price would I sell Hong Kong? I'm not, so Hanson, I'm not good with picking an arbitrary price. I'll look for some kind of retracement of this decline. You can put fib grids up if you want. Yeah, there's a fib grid. So somewhere between the 1/2 and 2/3 retracement looks good. If you look at the big picture decline and you want to step it up a little bit, instead of going in around 22.5, you can go towards 23, but somewhere between 22.5 and 23 would be my range. I had to do that. Okay, so that's all the indices, and that is emerging markets. Does anybody have any questions on emerging market before I move on? I'll drink some water. Okay, let's go on. Johanna, to answer your question, if you want to keep it, which I do, as simple as possible, you can just divide large cap growth by large cap value or small cap growth. So here's IVW, which is large cap growth, divided by IVE. And when the line is moving, when this price is moving up, it means growth is leading. And when it moves down, it means value is leading. That's the way you can see large cap value versus large cap growth, or any other growth versus value. So if you take a weekly chart, it'll tell you that for the most part, since the middle of 2013, growth has led. And the few times value led here, and the market was in a corrective phase. So it's been healthy that growth is leading value, because when value leads for a long time, you question the validity of the bull move. Not the bull market, it's the bull move. So that's how you can do an easy growth versus value. And the same thing, small caps, IJT, IJS, nope, I did it wrong, IJS. So here's small cap growth versus small cap value. It's been very healthy that small cap growth has been rocking the entire year. Huge move. That's healthy. Whereas last year, when small caps kind of sucked, and look what happened. It was growth trailed first half and then went sideways for the whole year. And then that's not so good. Let's see. So now, Johanna, guess what my next question is? Can you tell? Yeah, I just did it for you. So if you have any questions on that, just post them and I'll answer it. But that's the way I look at it. And there's another way to look at it, which is a little more quantitative. It's very easy to do. I think you're in the inner circle. Tiny, remind me next week. I will come join the inner circle discussion at 7:20, and I'll bring an indicator in an Excel spreadsheet, which they can use if they want to see growth versus value. Okay, let's go on. Let's do the three big, my big sectors. KBE, we'll do the banks first. Oh, not KBE. So here are the banks. I stand by what I've said for the last couple of months. I do like the banks second half of the year. I still like the banks. I think they're going to be a leader second half of the year, and they look fine now. They're oversold on stochastic. They haven't declined that much. The bond market has been trading poorly, and I think banks will be a second half of the year story still. So still like them. And I rate this chart, bullish still. Transports, which is a big rut row, they have been a complete and utter disaster in the last 4 months. And this is just crummy action. I have not read a lot from the Dow theorists about the bull market ending, although there's a couple of guys whom I make fun of in my blog, and Ralph Acampora is one of them. Although I took a class from Ralph 100 years ago, and he's a really nice guy. I've been on TV with him a couple of times. I think he's making kind of an ass of himself by choosing this magical number in the Dow of like 17,038. That if we close at 17,037, the bull market's over and we're in a bear market. But if we stay above 17,038, we're in a bull market. That's the most absurd research from a well-respected veteran. So I have not a lot of respect for that analysis. Sorry. The trannies look crummy. They still look crummy. I said they were a second half of the year story, and I wonder aloud whether I'm being too complacent. And they just trade. They cannot get out of their own way. And you can't say it's because of crude oil, because crude oil hasn't rocketed off to the moon. So the trannies kind of suck, and they counterbalance the good work the banks are doing. Finally, the stocks were great leaders, but look what's happened in the last 3 weeks to the stocks. They've come down pretty dramatically, not many green days, and they've traded below the March lows. This is an ugly mother candle right there. That is ugly last Thursday. You cannot ignore that candle. That is an ugly one. So of our three sectors, they're not in the world-beating shape right now, which is another reason why I don't think we're blasting off the Dow 20,000 yet. Let's go on to the rest of the sectors. Software is hanging in well. I've said it all year. It's a good, lower volatility sector to own. Hard to argue with it. It's done nothing wrong. Still like it. Telecom, oh my God. This is one of my sector picks for the year. And I keep repeating it because I don't run from my commentary. If I'm wrong, I'm wrong. So be it. This has been terrible. Thankfully, the scale is so small. It's a 50-cent scale, not a full dollar scale, so this looks worse than it is, but it's been crummy. Diversified financials, I still like the banks better, but they traded okay last week. There's diversified financials, which include the credit cards and the Berkshire Hathaways, etc. The consumer, which I've said every week, every month, every quarter, rumors of the consumer's demise have been greatly exaggerated. And if I just showed you guys this chart, there's not a single person among you. If I just showed you this chart and you had no idea what it was, you would not say this chart's bearish. I'm sorry. And I don't want to call anybody an idiot, but you have to be almost an idiot at this point. Now, maybe in a week it collapses and we change our mind, but every step of the way this year, we've said the XLY looks pretty darn good. In the face of this whole market pullback in here, The XLY looks pretty resilient. Retail, similar but a little weaker. That's just not the look of a consumer dying on the vine. Sorry. So I know a lot of you bears are hanging your hat on we're in a recession, the consumer is falling apart. Nonsense. And my home builders, which have been my sector plays of the year, continue to look really nice. They are resisting significant decline, and they look like they have another leg going to go higher. So I still own healthcare. I don't believe I made any trades last week. I think I own a 25% position. Looks just like the consumer. It looks pretty darn good. It's only a day or two away from all-time highs. So I'm holding on to my healthcare. But the problem I'm having now is there's a lot of bullish sentiment around healthcare. And how could there not be? Because you've had a big rally. Biotech, I still own my biotech. I own a 25% position, half of what it would be if I was really bullish on stocks, but biotech still looks good. Somebody's smart, somebody's been paying attention, somebody who knows me. What don't I like about biotech right now? It's not just just on price. What don't I like about biotech right now? Someone tell me. Oh, you got, so I think it's Rick is right. There's a divergence. So you got higher highs here, lower highs here. That's one. And two, who else? Who else got it? You know, divergence is one, but the big thing I don't like, Adine said it, I don't like these two candles. The two red candles, and right at the 50-day moving average, but I don't like these two reds being a sign of a bottom. Maybe it is, could be. You know, here we had it. I hated it, but it was. I don't like this. I'm still long, but I don't like these two candles here. That's biotech. That's healthcare. Here's XLI Industrials, like the really big, thick companies. We haven't loved it all year. I don't love it now. There's better money to be made elsewhere. XLB, I haven't loved it for years, plural, and I certainly don't like it now. It is not a late-stage bull market player, so I'm not interested in materials right now. Energy. So the XLE is flirting with a test of the old lows for the third time. We have a good reversal candle, but it's got to get going right now. Same with the OIH, which I bought more of. I scaled back to a very small position going into last week, and then I bought more of on the reversal day. So what's that, last Tuesday? If it does not get going the next 2 or 3 days, I will likely sell at least half, if not all of it. On the defensive side, IYR, which is Reits. I bought a little bit of Reits last Thursday here. Trading a little better than it has been. Not a world beater, but I did buy some Reits. XLU utilities. You already know I bought some here, and I bought some more down here, and I am expecting this to resolve itself up into here, where I'll probably start to do some selling. If it falls out of bed next week, then I will probably sell half my position, take a little profit from this, and hold on from here. But it looks like some of the defensive plays are bouncing into the market's uncertainty. Here's XLP. The staples have had a much nicer bounce. They're still not rocking and rolling like you'd see ahead of a bear market, but they're certainly not falling apart either. Hey, does anybody know if, I don't know, I'll talk about ADD. If ice road truckers begin soon, I forget to look. Anybody know if ice road truckers begin soon? Okay. So those are the sectors. Here's gold, which has been awful. And we're looking for some kind of bounce or a bottom, but nothing in sight yet. Those are the gold stocks. I've said this all year long. I'm looking for gold to trade sub 1100 sometime this quarter. So now we're at 1158, let's call it. The first sign of me getting bullish on gold will be gold below 1100. Other than that, it's going to be really hard to get intermediate term bullish. I could put on a trade, but nothing I want to hold for a long period of time. Silver, same thing. I think it's going to go sub 14, which is another 10% lower. I don't think we're there yet. Let's see. Copper. Here's copper. Tough one. Very tough. I mean, you could say you got a double bottom here. I wouldn't argue with that. We don't have volume to confirm it, but copper should bounce a little bit more, but I don't have a strong feel for copper. Natty gas. Smart money's been involved since like up here. This is the epitome of a commodity bottom. It's long and it just goes on and on and on and on and on. I'd much rather be long natty gas than short. So I think eventually we're going to go much higher in natural gas. We did crude already. I'll pull it up again. Here's crude. Certainly doesn't look good. We have a pretty good gap here. This may be a futures roll. I'm not sure. I don't recall. That was last Monday. I don't think it was a futures roll. Crude's oversold. The price chart looks terrible. Sentiment-wise, sentiment on crude is getting to the same extreme we saw down here, where it could and should support a long-term rally. So although price looks like it sucks, and it does, the sentiment's at a point where you got to pay close attention to crude. The dollar. I am still long-term very bullish the dollar. Intermediate term, neutral, short term, I guess neutral. Eventually, I think this whole pattern here is going to resolve itself higher. I continue to believe that the euro is going back to par or under and short any rally in the yen. I mean, so that's been my big picture now for many, many years, and I'm sticking with it, especially in the dollar versus the euro. So I think we're only halfway through the secular bull market in the dollar. And eventually, this dollar surge way above par and towards 120, that will befall the bull market in stocks if I have to really prognosticate over the next couple of years, but just not now. I think the dollar is probably at equilibrium. Thanks, Scott. July 19 for the first, my daughter's birthday, for the first episode of season 9 of Ice Road Truckers. Now I'm getting excited. Rick, on GDX, if we get a bounce here, where would you enter a short? That's a tough one, Rick. A good question, though. You know, I don't like to pick prices. I like to see how something behaves. If we kind of meander higher without an impulse move, then I would short, the first time the 5-day stochastic got over probably 75. But it's hard to give a level right now until we rally. Do you like Yoku here considering? Yoku's a tiny stock, so I'll have to tiny cover stocks in our inner circle session at 7:20. Okay, so those are the sectors. We cover the dollar. Here's the euro. I I've been, and I think I mentioned, I've been long the euro in small size for several weeks, and it looks like euro could poke above these old highs, at least come up and challenge them. So I'm sticking with the euro in the short term. If it goes down and I have to stop out, so be it. The yen has seen a nice rally. I've said it every session for I don't know how many years. Let's see. So since early 2012, I kept short the yen, short the yen, short the yen. You got your rally in the yen back to 80 and change. You have a divergence in the stochastics, and I'd add more to the yen on the short side. But you need staying power. This is a very long-term trade. Very, 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 very long-term trade. So we did the yen, the euro, the dollar. We did all the commodities except for the grains. Let's talk about TLT. Here's TLT. Hard to say it's traded well. It hasn't. It looks really sloppy. No trend. Candles aren't really helpful to me. I don't think there's an edge either way. The 30-year bond, yeah, no opinion on that either. Let's see. Junk bonds. Here's JNK, which I don't own. I haven't owned in a long while. I hate these tall red candles. You guys know how I feel about them. I may be wrong. I just hate these tall red candles. It's hard to love this chart right here. Very hard. Oversold, could support a rally, but I'd want to wait and see. The PIMCO high yield fund looks kind of similar to the junk bond fund. To me, I want to see some more upside before I would want to get excited. AD line in the stock market is back down to here. Nothing really to discuss on the AD line. Kind of is what it is. Scott Barron's blasted bond funds. Yeah, Scott, that's been Barron's kind of long-term theme for a while. They're blasting bond funds, and it's not hard. I mean, I don't want to say you're dumb to do it, but when you're not in a strong bull market in bonds, to own a bond fund, your principal's not protected. Bond funds don't mature. Individual bonds mature. So you can lose an awful lot of money. The reason people buy bond funds over individual bonds is because the yields are higher, especially those closed-end funds which have leverage. But to own like a long-term bond fund is a tough road to hoe in anything but a bond bull market. I guess it's fine if the bonds are going sideways, but it's really tough. Yeah, you're right, Scott. People will bail in a bond fund. They're better off owning the individual cash bonds, taking lower yield, but at least when the bonds mature, you get your money back unless the company defaults, which is unlikely. Okay. Let's go back and do the grains. Then I can take a shower because I stink and call it a night. So here, good. Here's wheat. So last week in wheat, last couple of weeks, this is again, here's your typical commodity bottom. It's long and frustrating, and then all of a sudden wheat goes. So wheat's been behaving well. On the surface, this looks like a pennant, right, Tiny? Right. Here's your impulse. Here's your pennant. It should resolve itself much higher. Okay, that's supposed to happen. In the last week, the smart money in wheat has bailed and it's gone net short. So it looks like the end of the move is close at hand. We could certainly blast off, and I hope we do. But just keep in mind, it's a much higher risk trade than it was 2 weeks ago, 3 weeks ago. Same thing in corn. We talked about it right when it blasted off. You got to get long corn, and it's cooperated really nicely. It is incredibly overbought, and no, I would not buy corn up here. And if you own it, I keep a stop in, probably over here for the time being, and I trail it up. But corn and wheat did a great job of listening. We talked about it. Beans, not as much. Beans are much sloppier. Hard to get excited about beans. It looks like it wants to go a little higher, but I don't love them. Cotton, kind of the same as beans. It had its rally. In the short term, I don't love anything in cotton. God, my typing stinks tonight. Sugar, here's sugar. It's been frustrating. Smart money's been in this for a long time. I like Friday's action. It should resolve or continue to resolve higher in sugar. Should. Coffee, again, like natural gas, smart money's been in at much higher prices, and it continues to hockey stick bottom. So eventually, I think we resolve ourselves higher, but there's no impetus or catalyst yet to do anything. And here's cocoa, which has been a beautiful mover. Still looks fine to me. Not as fine as it looked months ago, but cocoa still looks fine to me. Let's see. Oh, Johanna, I did not see your XLY question. If you wouldn't mind posting again, I'd appreciate it. I'll answer it. Oh, there it is. Would you say that XLY is showing a massive flat top, and when it breaks the upside, we will... Okay, let me take a look. And while I'm answering Johanna, post your questions because we're going to wrap up shortly. I would not call this a massive flat top because it continues to poke and make new highs. It's similar to a flat top, but the line in the sand, if you will, that little cushion continues to float higher. I mean, this, to me, XLY looks pretty good. Could I be wrong and this thing does one of these? Yeah, I could be wrong. The odds don't favor that now. A lot of times the odds favor me being wrong. The odds don't favor that right this second. Okay. Let's see. It's XLY. Let me go back to the questions. Brian. The tranny rally. Well, it hasn't been for a while. And the tell was when oil started collapsing, the tranny started going down too a while ago. That was telling you something ain't right. I mean, could it be a global growth story? Well, here are the airlines. You know what? Hold on. Let's do a real airline one. Here's the XAL, which is the airline index. That's really getting good. Let's dial down. Okay. So the airlines don't look anywhere nearly as bad as this, right? I mean, the airlines, the knock right now is, and this I like this action. You've got two good candlestick bottoms to shoot against, double bottom. Both are candlestick reversals, and Friday's action is pretty bullish. So the airlines look better than they have in a while. FedEx, not so much. Bad earnings up here. I think it was here. And it's just sold off. UPS, oh boy, disaster. So the UPS and Federal Express are kind of global growth stories. We're doing okay in the US, but not so well everywhere else. Let's see. The rails, Norfolk Southern, you tell me. That's a disaster. Union Pac, well, that's a disaster. So airlines look good, and the truckers and the rails. I'm sorry, the rails and the excuse me. The rails and the deliverers, not so much. And the reason is because we're seeing some divergence in where the growth's coming from. Let's see. Don, tiny cover stocks. We don't do that in this session. Jay, when you say smart money is in or out, it's based on the Commitment of Traders report. COT, Commitment of Traders report, that comes out every Friday afternoon. It just tells you which kind of people own a given security. Is it a large hedger? Is it a commercial? Is it a non-reportable, which is the mom and pop? So you want to be opposite mom and pop, and with the big hedgers. Still having a hard time getting to understand the flat top. So is it not really? No. So Johanna, I wish I had an example right now of a flat top. Did Biotech used to have one? Let me just take a look. No. Like here is a flat top, Johanna. Here is Biotech. Okay, you've got kind of 3 tops in a row. Flat tops, once you break out, usually go. They go. Or the go-goes. Here's a nice flat top. You know, crude was a beautiful flat top. Okay? Here it is. It never broke out to the upside. So flat tops you typically buy. If you want to be aggressive, you buy them a little early. If you want to be conservative, you buy them on the breakout. Never broke out here. So to me, I like flat tops. They're easy to play because if you're wrong right away. If you have a pattern with some higher highs in it, Johanna, that's not bad. That instead of in a flat top, you're kind of still in an uptrend, which is still pretty bullish. Tom, Tiny's here, but he covers stocks in a different session for our Inner Circle members. So if you're interested in that, we can get you some information. Or go to the website, winningedgetrader.com. Is it Beeb? Bib? My thought on natural gas is the smart money's been in it for a long time at much higher prices, and I think eventually natural gas will resolve itself much higher. Is it going to be this month or next month? I honestly have no idea. I don't have an opinion. Other questions, comments, concerns, quibbles? Last call. I feel like the male bartending day is last call for alcohol. Anybody else? Going once. Going twice. Oh, one thing I didn't bring up, which I will as I end. I didn't bring up my 3. Here's internet sector ETF, which still looks pretty good to me. If I needed a long, I'd probably look here because it's got some decent momentum. Social media stocks, not so much. Look like kind of dog poop. I'd avoid them right now. TAN, I forget who likes TAN, still is not good. Gap of recognition was pretty strong here with that Chinese solar stock that wet the bed, and it's been a disaster ever since. Do you think if earnings are good, it will help the market to go up? I think earnings have to be especially good right now. But more importantly, it's if the companies give any forward guidance. China, I mentioned, I don't think the lows are in China. I think you can probably sell the bounce. Does the bounce go farther than we all think? Could be, but it just doesn't look, it looks like there's a lot of pent-up selling that whenever they let go of those ridiculous manipulative restrictions, China's going down again. Hack. I like Hack as a long-term play, which is really not, my usual comments on a sector, but I do like Hack in a long-term play. I mentioned it on the Charles Payne show, and I liked FireEye. Now it looks good, but I mentioned I liked FireEye. I think it was 35-ish. Now it's 42. I still like it, although now it's 49. Sorry. So I do like this sector longer term because I don't think these hacking incidents are going to go away anytime soon. So Hack's a goodie for me, and I think you can probably do some homework and isolate a couple of stocks to play in the hacking sector. FYI, for those of you who care, I will be on Yahoo Finance's live show, which I did not know they had. I'll be on Yahoo Finance this Thursday at noon, live from Yahoo Finance Studios, and I'll be on the Charles Payne show on Fox Business Thursday night from 6 to 7. So Thursday at noon on Yahoo, Thursday night on the Payne show from 6 to 7. If there are no other questions, we will call it a night, and wish you well during this week. It's going to be volatile again. See ya. All right, Tiny, all set.
Everybody, see you next time.